This week started off ugly and it only got worse. And we really exposed one of the main issues in the market, which is that we've been gearing towards like an early cycle trade when all of the data is pointing towards end cycle. Here's how we got here. Stocks red, bonds green, dollar yellow, crypto red. Crypto's been red for a while. Bonds went green yesterday. We got the bond rally today despite quite a fight. I'm surprised bonds didn't rally more, but it was a pretty strong week for Treasury bulls. That was a big part of the story here as we continue to leave the door open for 50 basis points, possibly if the data go worse or if the inflation numbers come in light. But it's not the type of lightness that you want in the data. That's why stocks have been red. Now, if you rewind over the last 3 months, you still can trace a lot of the market's inner turmoil back to mid-July with the first light CPI print, July 10th. That was the high for the NASDAQ. Risk radar had been green on stocks, turned yellow 1 day off of that high. And since then, things haven't been the same. With the NASDAQ struggling, clearly in a downtrend, now the S&Ps joined this week. So a few weeks back in the late August trade, the light went back green, but then we got stuck in the range. Then August 29th, we went red on the risk radar, yellow first, then red on the third. So that's where we're at. When you break range and you move lower, that's when the red light came on, because that's what technical analysis is. So when we broke through that to the downside on Tuesday, there wasn't a lot of option here for bulls, but to kind of cave because they put up such a strong fight last week. When Nvidia tanked to start off the week, you knew that we were just in trouble here. We've lost the momentum trades. We've lost the AI trade. Broadcom, again, not even close to what the expectations were for guidance. That was a bad number. And that's where today started off on the wrong foot, too. But it wasn't just the AI trades that are deflating basically on their own, kind of unrelated to the economy, just a secular boom that now maybe is not busting, but is definitely fizzling and disappointing. That's your first problem, but you can actually kind of set it to the side for a minute because the AI story is a beast of its own, and we're going to have to continue to deal with those valuations coming off. But what we got this week in the economy was also crucial information. Look at the dollar versus yields and how this traded today, because yields continued to break down. We got the lower low in yields that I was looking for. It wasn't quite as dramatic. And all of this came about a week later than I was expecting. Thought it would happen around Nvidia earnings last week, but maybe it was the holiday. So it kicked in this week. We got the new low for the 10-year yield, but then a major battle today with the 10-year ending at 3.7 and unwinding some of those odds of 50 bips back down below 40%. So the dollar's still sitting above the 1-year low, and that's important. That's why I've got the yellow light on the dollar, but not for bonds, because bonds look like they're trending, yields down, price up. That's why the green light's on bonds. But the dollar is still, I think, neutral because it's held onto the 1-year low. And also the dollar gets more complicated when stocks are selling off. Because when stocks start to sell off like they are, some of these high conviction, higher correlation sell-offs, the dollar catches that safety trade, basically, the kind of cash hideout. So that's where the dollar, I think, has potential to hold here. Looks like, though, most scenarios, at least kind of 2 out of the 3 basic economic scenarios, do send yields lower in the short term until we start to really see economic data impress again. The numbers are not impressing. They're not good. The market has been geared towards an early cycle style of leadership with small caps and rate-dependent trades and cyclical stocks, the stuff that does well out of the recession, basically. But the point that I'm saying is that the underlying data are not just not early cycle, they're end cycle. The other big thing that happened this week was the uninversion of the 10s to the 2s. And anytime that happens, that's when actually you're getting to the recession soon. The yield curve inverting is just a prognosis that says that the market and the economy has problems underneath. When it uninverts is when those issues start to show the worst of symptoms. And so the economic data are telling us we're late to maybe end cycle, but the market's been trying to pivot to early cycle. That's a major clash and conflict. So it seems like risk off will be the tone until we get a really good, surprising piece of economic data. The other point is crypto and Bitcoin. Watch it over the weekend. The line there has been clear, the channel's been clear, and that's why I've had the red light on it. It has to hold this here. Look at how quickly BTC went up into the whole ETF run. There's barely any support below here. That line's gotta hold or else it could be a massacre in crypto. Watch it this weekend. It's already been selling off a good amount. Not sure if it's gonna move. It doesn't really move that much on the weekends anymore. If it does, that probably tells you that people really need to tap in to find some liquidity outside of market hours. Thanks for tuning in. Hope it was helpful. Have a great weekend.